Some good recovery on both the foreign exchange market as well as the stocks. But starting with the currency front, we saw the Kenyan shilling farming 0.2% to close the day at 85.5070 per dollar, and that was compared to Tuesday's close of 85.86 on 85. Looking at the Nairobi Securities Exchange, on the other hand, it broke an 8-day losing streak, with the benchmark index inching up 0.1% to 4,705.19 points. The main share index has dropped 5.9 points since June 6th, and this was a 14-week low. With us in studio, we have Samuel Geshohi. He is the Business Development Manager at NIC Securities. Many thanks for joining us.
You're welcome.
The recovery that we're seeing in both the foreign exchange market and in the stock market, is this something that we can expect to continue, or is it a knee-jerk reaction to some news that we might have had yesterday?
Yeah, I think now that we are seeing the government begin to react, I think there's been a lot of lobbying, especially in terms of the capital gains tax and the VAT bill, and I think that we have seen that there is a bit of headway on that, and the government has started to at least react to that, which might be bringing in some confidence on the fact that, one, we were worried about inflation going up, because if the VAT bill is implemented, then commodities, will go up, the prices of commodities.
Looking at foodstuff?
Yes, especially consumables and foodstuffs, and that would really push inflation up, which is not really good, especially when we are in a declining interest rate regime. I think also the capital gains tax, particularly for the stock market, I think they might have a more targeted capital gains tax, where maybe they look at real estate, but and maybe mining, but with this, our stock market is very small in comparison to some of the bigger markets. We are still trying to get companies to come to the market. We're still trying to get the common wananchi to begin investing in the stock market. So putting in a capital gains tax is really detrimental. It happened in 1985, the market crashed. Why would we want to go that direction?
The fact
again?
that Treasury actually spoke about it for the first time since we had the budget, and said that they have not yet laid down the policies on how they want to do it, has this brought some level of optimism for the investors?
I would expect so, because investors were very worried. Personally, I've been talking to quite a few investors, not just the high net worth, even the retail, with small holdings, and they are all wondering how it's going to be done. You bought shares so many years ago, and now you're selling them. How are they going to calculate these capital gains? Some of them have been holding for a very long time, and if they felt like, coming out, the stock brokerage fraternity and the investment banking fraternity is also worried about it, because for them it means that a slump in the market could lead again to massive.
So can we expect an upward trajectory going forward, or?
We are hoping so. I mean, at the end of the day, it is what the decision that is made, the final decision, but at least something being said about it and something happening to show that the government is listening, then maybe is giving a bit of confidence back.
And of course, yesterday we saw some of the two biggest banks, KCB and Equity Bank, recovering quite substantially. We saw KCB up 4%, and Equity, on the other hand, was about 2% up. Is it something that you see will actually spur the market?
Well, those went down to their levels of support. I think there was a lot of profit taking. At the moment, they started to show downward momentum, and so when they reached their recent lows, then investors started to get in, because they feel that they have reached a level of support, and therefore there was that tendency to start getting back in. So I think that we could see them at least hold up for the moment.
Which is the stock that you're looking at and seeing it's a good pick at the moment? Because I think these are now good bargain prices.
Yeah, I would be going for some of the banking stocks. I mean, one thing that we must realize here is June is usually a low time for markets, January and June. Then they start announcing maybe in the next 1-2 months, July, August, we'll get the half-year results, and that is going to again spur the market. So that is one thing that can cause you to realize that it's a good time to get into financials now, with the hope of, say,
positioning yourself
for those announcements that will come, hoping for interim dividends and good results half year, and that would push them up towards September. That said, I would still be looking at energy, and I would still be looking at
Why
the cement
energy?
sector. I'm thinking that we are going into a very strong development phase, and so in the longer term, I would expect that we need to invest very heavily in energy. I would also expect that we're going to see a lot of infrastructure spend, which is going to benefit both energy and the cement sector.
Let's look at the debt market, whereby yesterday we saw the central bank auctioning the 182 and the 364, and we saw the 182 dropping by about 13 basis points to 5.6%, levels that's seen in 2011, and we had the 364 dropping about 18 basis points to about 8%. For you, do you see like this is the bottom level that we can see on the debt market for the short end papers?
Well, the margins are narrowing, which is a signal that, and they're picking less, and that means that that is a signal that we could be reaching a bottom. And the shilling has also, shown some signs of weakening, and that would also mean that it would be a reason for it to bottom out, and maybe we could see, if especially we get higher inflation rates, we could see the interest rates begin to slightly shift upwards. But I do not expect that to happen if we continue to remain below the 5% target on inflation, and so we're hoping that we'll
given the
there.
government's need that we saw from the budget, they require 1.6 trillion shillings, and they're borrowing about 106 billion from the domestic market. Does that mean that as we go into the next financial year, we're likely to see heavy borrowing, and probably the rates are likely to shoot up?
Well, I'm hoping finally they'll go through with that euro bond, because that will give them, another avenue for borrowing. I think we need also to have, international rating agencies coming in and rating our bonds, because that would also attract some foreign, investors into our, fixed income markets and more activity. Because when you're not rated by international agencies, then your sovereign debt is not rated, then that means that you don't get a lot of attention from the sorts who would want to buy sovereign debt. That said, I think, yes, the government will need to borrow more. And of course, that would mean that they might even need to increase interest rates to attract those funds.
All right.
But again, it is not in their interest to really increase interest rates substantially, because then it would mean that it would hit the banks, borrowing would become more expensive,
to have a very large
and then
cyclical
investment would be a problem. So, it's
balancing act.